Hey everyone, welcome back to Corporate Decoder, the place where we expose the hidden stories inside those big corporate filings in this video. We are going to dive into the annual shareholder report for a fund called the GammaRoad Market Navigation ETF. You might be wondering why we are looking at this specific report from a fund that only started operations in September of 2024. Well, sometimes the newest players can give us a really interesting look at how things are working right now. So what is the story here? This report is essentially the fund telling its investors, hey, this is how we did over our first year. It is packed with numbers about performance costs and what exactly the fund invested in. It is a pretty standard report, but we are going to cut through the jargon and pull out the key takeaways for you. And hey, if you like getting these kinds of straight-to-the-point analyses from SEC filings, make sure you are subscribed and join our Discord community, linked in the description below. We've got a great group of folks breaking down these reports together every week. Let's kick things off with the big picture, the size of the fund. As of the 31st of August 2025, the total net assets stood at a respectable $5,788,527. This is the total value of everything the fund owns after subtracting its debts. It is a good starting point to understand the scale of the operation. And if we look at the fund size in thousands, it is reported at $5,789. This means the fund is not a giant behemoth, but it is by no means a small startup either. It is in that interesting middle ground where it is established enough to have a track record but new enough to still be finding its footing. Now for the part everyone really cares about performance, we have a few interesting columns here. The first is of course the GammaRoad Market Navigation ETF itself. For the period ending the 31st of August 2025, it showed a $10,674 return on a hypothetical $10,000 investment. That is about a 6.74% gain. Not bad for its first year. However, when we compare it to the S&P 500 Total Return Index, which saw a $11,610 return, meaning a 16.10% gain for the same period, the GammaRoad ETF lagged behind significantly. This is a crucial piece of information. It means that while the fund made money, it did not keep pace with a major market benchmark. Even the fund's own strategy index, the Market Vector GammaRoad US Equity Strategy Index, performed better with a $10,706 return, which is about a 7.06% gain. So in its first year, the fund slightly underperformed its own stated strategy and quite significantly underperformed the broader S&P 500. This is something we need to keep an eye on. Let's look at the annual performance section to solidify this. The GammaRoad Market Navigation ETF returned 6.74%. The S&P 500 Total Return Index returned a much stronger 16.10%, and the Market Vector GammaRoad US Equity Strategy Index returned 7.06%. This confirms that the fund's strategy did not beat the market in its inaugural year. What might explain this underperformance? One key metric is the portfolio turnover rate. This tells us how often the fund is buying and selling its holdings. A rate of 315% is very high. This suggests that the fund is actively trading its investments. High turnover can lead to higher transaction costs, which can eat into returns. So while they might be trying to capture market movements, this level of trading might be working against them. Let's delve into what the fund actually invested in. As of the 31st of August 2025, the fund's main investments were in exchange-traded funds, or ETFs, totaling 99.6% of its net assets. This means that the fund's performance is essentially tied to the performance of other ETFs. The largest holding by far was the eShares Core S&P 500 ETF, which made up a whopping 67.1% of the fund's total net assets. This is a very concentrated position in an ETF that tracks the S&P 500. The second largest holding was the SPDR Bloomberg 1 to 3 month T-bill ETF at 32.5%. This is a very conservative investment focused on short-term government debt. So what we see here is a fund that is heavily invested in a broad market ETF and also holding a significant portion in very low-risk treasury bills. This combination explains why it likely underperformed the S&P 500. The T-bill portion offers safety but very little return. Now let's talk about costs. The total advisory fee was $31,107. While this number might seem small in isolation when you factor in the fund size of $5,789, $1,000 IT translates to a significant percentage. This is further clarified in the financial highlights. The ratio of expenses to average net assets before any waivers was 0.75%. This is a moderately high expense ratio for an ETF, especially when you consider it is investing in other ETFs which already have their own expense ratios. However, there is a glimmer of hope here. The fund's advisor has waived some of their fee, bringing the expense ratio down to 0.66%. This waiver is in place until at least the 30th of November 2025. This reduction helps to make the fund more competitive, but it is still on the higher side for passive investment vehicles. Interestingly, the report mentions that the fund uses other ETFs as its primary holdings. This means the fund's performance is not only subject to the general market risks, but also the specific risks of the underlying ETFs. For example, the report highlights the risks associated with the SPDR Bloomberg 1 to 3 month T-bill ETF, including debt securities risk, and the SPDR S&P 500 ETF Trust, which carries equity market risk and tracking error risk. It even goes into detail about leveraged ETFs if they were to be used, which this fund isn't directly doing, but it shows the fund is aware of the complexities of its holdings. Reading through the notes to the financial statements, we see that the fund's investment objective is to seek capital appreciation. However, the actual investments as disclosed in the schedule of investments show a strong tilt towards safety with 32.5% in T-bills. This creates a disconnect between the stated goal of capital appreciation and the actual portfolio construction, which favors capital preservation. The report wisely includes a disclaimer that past performance is not a guarantee of future results. This is especially important for a fund that has only been in operation for less than a year. So what is the takeaway here? The GammaRoad Market Navigation ETF had a modest performance in its first year, lagging behind both the broader market and its own strategy benchmark. Its high turnover rate and significant allocation to low-yielding T-bills, combined with its reliance on other ETFs, point to a strategy that is perhaps too conservative for its stated goal of capital appreciation. While the fee waiver is a positive step, it doesn't fully compensate for the underperformance relative to market indices. The fund is essentially paying a moderate fee to underperform the S&P 500. Looking deeper into the financial statements, we see a net investment income of $78,895 and a net realized and unrealized gain of $215,027. This sounds good, but remember this is over a very short period since inception in September 2024. The fund's holdings appear to be a mix of growth potential in the S&P 500 ETF and a safety net with the T-bills. The question is whether this balance is right for the stated objective of capital appreciation. On the flip side, the fund appears to be well managed from an operational standpoint with a clear structure and an experienced advisor. The fact that they proactively waived fees also shows a commitment to investor interests. However, the core performance numbers are what investors will focus on. In conclusion, the GammaRoad Market Navigation ETF is in its infancy. It has shown some positive returns, but has not yet demonstrated an ability to outperform its benchmarks. The strategy needs to be closely watched to see if it can effectively balance capital appreciation with capital preservation without sacrificing significant market returns. The high turnover rate and the heavy allocation to T-bills are areas that warrant investor attention and perhaps a re-evaluation of the fund's investment approach if the objective is truly capital appreciation. For now, it is an ETF to observe from the sidelines rather than one to jump into based on this initial year's performance. Alright, that is our breakdown of the GammaRoad Market Navigation ETF's annual shareholder report. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.